If you followed the news last week, you would have heard about share markets globally taking a bit of a dive. And it's no surprise that investors get nervous when that happens. So today I want to talk about market volatility, what that means and how to best manage that in our investments. Firstly, if you know anything about the share market, then you know that share prices can go up and they can come down. And that's what we call share market volatility. And it can be influenced by political, economic, social and industrial factors, amongst others. It's inherently risky, but with that risk comes the potential of a long-term reward. We've got to understand the investment risk and manage it as effectively as possible to make sure we get the best outcome in the long term. And a lot of what we do as financial advisors is based around managing investment risk. So how do we do it? The first thing to remember is that when markets are down, you have to avoid the temptation to sell. Okay, and that's easier said than done, I understand that. Your portfolio could be down 10%, 15, 20%, and you start to get nervous, right? You get those voices in the back of your head saying, is it going to fall much further? How much more money am I going to lose? But remember, you haven't lost any money until you actually sell those investments down. Otherwise, it's just a loss on paper. And markets move in cycles, so when it's gone down, chances are it'll come back up. Okay? So take a long-term view to investing in shares and give your portfolio time to recover. More often than not, it will, and you'll get a better outcome than trying to time the market. If you're into picking short-term winners, then you probably have just as much luck punting on a horse in the Melbourne Cup than picking a few stocks here and there in the share market. So one way we manage risk is through diversification. And all that means is that we spread the portfolio out across different asset classes, reducing your exposure to any particular asset class. So for example, if the share market drops by 20%, your portfolio might only drop, say 10%. So you're effectively smoothing out that market volatility. The extent of diversification is closely linked to your risk profile. And that's something we spend quite a lot of time on with clients to really determine how comfortable they are with taking on investment risk, how much risk they can take on, and how much they can afford to take on, depending on their situation in life. So if you'd like to discuss your portfolio or your risk profile further, please come and speak to us. But remember, share investing is about long-term strategies. Play the long game and don't get distracted by short-term volatility. Take care, have a good week, see you